Hi, it's nice to have you here again. In this video, I'm going to show you some really good stuff that I have prepared for you today. It's basically a video on how you can build a swing trading strategy. I'll show you the main strategy components and give you the technical tools for implementing them. And if you watch the whole video, I'll give you instructions on how you can build a trade size calculator that keeps your risk constant. First of all, please do remember that we don't provide any investment advice and all the material is made available for educational and marketing purposes only. And please remember to subscribe to the channel. That would be a great help. Thank you. Okay, so what is swing trading about? Basically, we are looking to catch these price moves that are sort of so-called directional moves in an uptrend or in a downtrend. So this is how the markets kind of breathe. They have a significant move to the upside and then a smaller retracement when the market is trending higher, obviously. When markets are trending lower, that's the opposite. But let's look at this uptrend example here. There's a bigger move to the upside, smaller move to the downside, and then some consolidation and then a move higher again. Another retracement and another push higher. So as swing traders, we want to have tools in our toolkit so that we can create strategies for catching these directional moves. And what I'm using here in this example is price crossing the SMA. This is the buy signal obviously here. And then when the market crosses above the upper Bollinger Band and then comes inside the Bollinger Band, that's the sell signal here. So this is one way of doing it, but in this video we're going to look at some other options too. And really the essence of this idea is that you want to catch one swing, then you look for the next one, you catch the next swing, and then you start to look for another one in this same market or in some other market. But basically the idea is to just rinse and repeat the same process over and over again. Let's take a look at the necessary components for creating a swing trading strategy. So what's needed? At least you need to know where to buy, where to sell, what technical tools to use, and how to manage the risk. Here are the components. Every strategy has to have at least these 4 components: trend recognition, entry strategy, risk management, and exit strategy. The point number 1, you need to understand what is the environment that you are working in. Is the market currently trending higher? Or is it range bound? Or is it moving down? And then you have to have an entry strategy optimized for each of the environments. There is no strategy that works in ranging markets, up markets, and down markets. You need to have one strategy for ranging markets, one for uptrending markets, and one for downtrending markets. So you need to define the entries and exits accordingly. Then the risk management. Obviously, at the time of creating the strategy, you need to decide how much you are going to risk per trade, how much you're going to risk per day, per week, how much drawdown you're going to allow on your account over any given time frame. And once you have nailed all these, then comes the testing phase. Then comes the phase where you go and statistically test, either manually or you write a computer code or you pay somebody and they program it for you. But the point is you have to go and have the strategy statistically tested one way or another. The ideas I'm presenting here, they are just ideas. They're not statistically tested. And basically I'm just saying this out loud so that nobody goes and just grabs some of these ideas and starts to trade with them. The idea is that I'm giving you tools and ideas and concepts that help you to decide what kind of strategy you will have. Then you test it, and if you rely on it, if you see from your results that this is something that actually has long-term edge, then you go and start using the strategy with live money. Okay, let's take a look at trend recognition tools. So basically I'm going to cover moving averages, breakouts, and market structure. Here I have a filter built with moving averages. So basically there's three options. First of all, you can have a simple filter where the price is above the moving average. And then if you want to have a system that is totally based on moving averages, then you say that I want to have the fast SMA above the slow. And if you want a little more precision, then there's this option of having three moving averages like I have here, the fast, the medium, and the slow. And if they are in this order, then the market is trending higher. Then let's go and see the downtrending market. The same applies here. If you have price below the SMA, then you have the system one is working here. That's the filter. And obviously all of these are true at the same time, most of the time. But then the system where you have, for instance, three moving averages, when you have the red moving above the green, so the fast is moving above the green, that sort of gives you an advance warning in some situations that the market might be actually now starting to move sideways or move higher. So this is really your preference. I think I like this idea of having either one or two as a filter. In my experience, the 3 SMA system doesn't bring that much added value to these 1 and 2, but I just wanted to present them to you just in case you want to consider and study those. Then the bullish breakouts and market structure. So basically the market is trending higher here. The market moves the market moves higher in a directional move, creates a higher low, and then goes above this high. So we know that there is an uptrend in place. Then the same repeats. We have a higher low and the market moves above the recent high. So we know that the market is likely to be in an uptrend. And that is one of the sort of the best filters you can have for an uptrending market. When the market is trending lower, you have the same, basically as a mirror image, you have the market making lower highs and directional moves are longer and bigger than the contracting moves, and then supports are broken. So basically market creates a bearish structure all the time and breaks support, so you know that the market is trending lower. That's when you can start thinking about the entries. Okay, let's talk about the entry strategies next. So first of all, the market is trending higher. It's moving above the moving average and the moving average is pointing higher. So we know that we have an uptrend. Here's one option for an entry signal. The times when the stochastic oscillator goes into oversold territory in an uptrend, they are very rare. Like here it happens only once. But it goes below the 50 level quite often. And if we get the percentage K, the blue line, crossing above the percentage D, the red line, in the stochastic oscillator, then we have a signal. And I think the settings here was 10, 3, and 3 if I'm correct, but you can try other settings for the stochastics. You can try 7, 3 and 3, or 7, 5 and 5, etc. and see what works in the market that you want to trade. So that's when you have these signals in uptrend, those could be very valid buy signals. And here we have the same concept using the RSI. So basically RSI goes into the oversold territory when the market is trending higher and then comes back. So that signals strengthening the market because the indicator doesn't do anything without the market doing it first. So basically here's a buy signal. There was another one. This one here led to a little bit of a sideways movement and then a small rally higher. But then the price came below here. So you might want to have your stop somewhere down here just in case this move continues lower. This is just highlight. I'm just saying this so that you remember that the risk management is the key. You have to have something that limits your losses. And it also reminds you that there is no single strategy that is perfect. They'll be losing trades, so you need risk management measures. But with the second signal here, the market moved quite a bit and continued higher in a trend. So that gave a good signal to go long for a swing trade. Next, I want to introduce you to the concept of inside bars. So basically here we have several inside bars. They are basically candles with high and low inside the previous candles high and low. So here we have the massive move down, even though the general trend in the market was to the upside. And then there were these candles here signify that sellers just can't push the market into new lows. Instead, buyers start to push the prices higher little by little. So that's something that you could use as a entry technique in an uptrending market. And then entry signals in a downtrend. The market keeps on making lower highs. It keeps breaking support. So we know that it's in an uptrend. And now the signal to sell could be something like this. This is stochastics 10, 3 and 3. So we have the stochastics oscillator above 80 and then the percentage K crosses below the percentage D. So that's a potential entry signal. And after some sideways movement, the market gave another signal here and then dropped a little lower. And then with the next rally failure, we had another signal there. And the same goes with RSI. This is RSI 14 periods. It just gives the signals at slightly different times, but the principle is the same. You look for RSI above 50 level because when the market is trending lower, the RSI rarely goes above the sort of threshold level where it would be overbought. So whenever it goes above 50 in a downtrend, that might be the time when you start looking for weakness, and that the weakness results in the RSI crossing below the 50 level, and that's basically is a signal to short. That's something for you again to study and see if this works in your trading. With risk management, it's highly important that you use a systematic approach. You keep your risk constant and you increase the risk only if your track record allows it. The track record needs to justify the increase of risk. And just make sure that your psychology isn't impacted either, because you need the mathematics work and you need your brain and your psychology to work optimally so that you can actually execute your trading strategy and stick to it. So here I have one of those setups that we have covered in this video. The market is trending higher and then we have stochastics signals here. Now, the question is how many contracts or how many lots should I be buying when the signal comes? And this is something you have to define before you actually start trading. This is for the time when you actually are creating the strategy, writing your trading plan, and then later on you move on to test your strategy. But let's assume that you have $5,000 on your account. And then you use a stop size of 30 pips, like here in this example. So the signal comes at the close of this candle. So I'm using, in this example, 30 pips in this market in both occasions. And if you limit your risk to 2% on every trade, then that's $100 out of the $5,000 account. That gives you the position size of 0.33 standard lots or 0.33 contracts, whichever language you prefer. Now, let me show you a neat little calculator that I created in Excel that helps you to do this. Just a moment, I'm going to bring the Excel up now. Okay, this is a simple calculator that I created for this presentation. I'm going to show you the formula so that you can copy this for your own trading. And basically I have highlighted green, these input sort of cells here I have highlighted with green so that I know which ones not to touch. So for instance here is one with a formula in it, so I know that I'm not going to touch this because it's not colored green. So it's the same setting here, the $5,000 account. We are going to risk 2% per trade, which means $100. And that's obviously quite simple. You multiply the 5,000 by 2%. So that's easy. Then you define your stop size in pips. It could be 45, it could be, it could be 60, whatever. But you can see here that the bigger the stop size, the smaller the position size. So that's the main principle behind this calculator. It keeps your risk constant even if the stop size increases. So then the risk per pip calculation is there. You divide the risk per trade by the number of pips. And then you have the nominal USD traded. So you take the risk per pip and multiply that by 10,000. And then this cell here gives you the standard lots traded. So I've multiplied the nominal USD traded, divided the nominal USD traded by 100,000. And here I have another example for you. The account size is the same. The stop size is 40 pips this time. The risk remains the same at $100. So the position size is now smaller. Instead of 0.33 lots, it's now 0.25 lots. So this is the principle that helps me to keep my risk in control. So here you can see the calculator again. I have the 40 pips there and it gives me nominal USD traded at 25k and the standard lots. Therefore, because one standard lot is 100k, therefore the 25,000 is 0.25. Okay, and then we finish with a couple of slides on exit strategy using the very same principles here. Now we are looking for long exit signals when we have bought earlier and the market has moved higher and started to move lower. That's one possibility to look for exit signals is to use the stochastics again. So you would be looking to sell when in an uptrend the market is starting to roll over, because obviously we don't know if this is going to be a deeper. We just want to catch the beef in the market. Here the same, that would be the place to go look for a buy signal or long entry, and then the sell signal comes when the stochastics gives a signal above the 80 level, when the percentage K crosses below the percentage D. And then the same principle with the RSI. Now that we are in an uptrend, RSI tends to go into the overbought zone more easily, but when it crosses below from there, that might be your exit signal when you are building a swing trading strategy. And one more, bearish inside bars. We have these candles here that are both the high and low. The whole range of the candle is inside the previous candle's range. There roughly it sort of slightly comes out, but I would still say this is pretty much an inside bar, and there definitely we have an inside bar. So these can act as sell signals for your long trades when you're building a swing trading strategy, because quite often they signify that the market just can't push higher, it's losing momentum. Alright, I hope you found the video helpful. If you did, please give me a thumbs up. share the video with your friends, and also maybe you want to leave a comment in the comment section below. I'll see you on the next video. Meanwhile, trade safe.